In 2026, the U.S. economy was depicted by numbers that remained stable, non-negative growth, a non-collapsed labor market, and inflation that had cooled from its peak. On television, charts showed a slow upward trend. In reports, familiar terms appeared frequently: soft landing, financial stability, market confidence. But at the same time, another phenomenon was unfolding in silence. Not in shopping malls. Not in protests over the cost of living. But in the closed rooms where the U.S. government borrowed money week by week to survive. There, bond auctions, considered the most tedious and safe activity in the global financial system, began to send unusual signals. Yields were higher than expected to sell the same amount of debt. Long-term demand was becoming hesitant. The familiar buyers were fewer in number and more cautious. And in technical reports that very few people outside of Wall Street read, signs of strain are beginning to repeat with increasing frequency. This is not a new story in the history of superpowers. Before money depreciates on the streets, before society reacts with tangible instability, empires often weaken from the least noticeable place, the ability to borrow at reasonable cost. When confidence in debt shakes, everything else is just a consequence. What makes the current phase noteworthy is not the level of panic, but the normalization. The system still operates. Indicators are still being published. People still go to work, still consume cautiously, and still hear that the economy is adjusting. But the question is no longer whether the American economy is growing. What happens when a nation has to pay an ever-increasing price just to borrow money, while the lives of its people do not become any easier? And when the cornerstone of the entire system, confidence in public debt, begins to be challenged, who will silently bear the remaining costs? In 2026, the picture of the U.S. economy was presented to the public in familiar and orderly language. Official reports emphasized that the economy had passed the most volatile phase of the post-pandemic cycle. Inflation, while not yet at absolute target levels, was described as better controlled. GDP growth was not high, but sufficient to avoid a technical recession. The labor market was no longer overheating, but maintained an acceptable unemployment rate. In this narrative, the U.S. economy was neither booming nor collapsing. It was depicted as a large machine slowing down in an orderly manner. In financial media, the central argument revolved around the concept of relative stability. After years of monetary tightening, the maintenance of high interest rates was interpreted as the necessary price to re-establish fiscal discipline. Public debt is acknowledged as large, but it is often presented within a historical comparative framework, where the United States has borne even higher levels of debt after the war without losing its global economic standing. This presentation creates a sense of continuity: the system is accustomed to large debt, and is still functioning. The stock market, despite its volatility, continues to be used as a barometer of sentiment. Each major index rally is interpreted as evidence that investors still have faith in the American economy. Technology, artificial intelligence, and automation are highlighted as new growth drivers, capable of offsetting slowdowns in traditional sectors. At the policy level, messages are kept neutral. There are no longer strong pronouncements about a war on inflation, but neither have there been clear signals of easing. The central bank is described as data-dependent, ready to adjust if conditions change. Fiscal expansion continues selectively, focusing on infrastructure, strategic industries, and national security. All of this creates a consistent narrative: the U.S. economy is in a difficult but manageable transition. In that narrative, risks are acknowledged, but placed within a framework of governance. The budget deficit is discussed as a long-term issue, not an immediate crisis. The bond market, if mentioned at all, usually appears in the form of weekly yield figures, rarely placed at the center of the macroeconomic narrative for the public. The language used is conciliatory. Phrases like adjustment, rebalancing, and soft landing appear repeatedly. They don't deny the difficulties, but neither do they question the limits of the system. The focus remains on avoiding the worst-case scenario, rather than questioning the structure that created the current precarious situation. For many who follow the economy through newspapers and television, this picture seems plausible. It explains why there hasn't been a deep recession, why markets are still functioning, and why major institutions haven't yet fallen into open crisis. It also reinforces the belief that lingering tensions are merely the aftershocks of an unusual period, not a sign of a fundamental problem. However, this very portrayal of stable but fragile obscures a crucial reality: macroeconomic indicators can maintain a facade of order while underlying pressures build silently. When the economy is told primarily through aggregated data and market reactions, the gap between the official picture and the daily experiences of millions of people can be easily overlooked. The surface picture, therefore, isn't entirely wrong. It simply fails to explain why more and more Americans feel the economy is unstable despite reports suggesting it's holding steady. Looking solely at aggregate indicators, 2026 doesn't appear to be a crisis year for the U.S. economy. However, observing how people adjust their daily behavior reveals a different story. The sense of insecurity doesn't stem from a single shock, but from the prolonged erosion of real income and the ability to control personal finances. Nominal wages continue to rise, but at a pace rarely keeping up with the accumulated cost of living after years of high inflation. Housing prices and rent, while no longer soaring, remain stagnant, preventing many households from returning to their previous spending levels. Health insurance, tuition, childcare costs, and consumer loan interest continue to account for a larger proportion of household budgets. For many workers, the absence of a recession simply means they haven't lost their jobs, not that life is getting easier. This gap is particularly pronounced among the middle class. This group is not poor enough to receive direct support, but also not wealthy enough to absorb cost shocks without sacrifice. Many households are forced to maintain their living standards by increasing credit card debt, extending repayment periods, or delaying important decisions such as buying a house, having children, or changing careers. These behaviors don't appear in GDP reports, but they reflect a prolonged state of financial survival. At the community level, the signs are also becoming clearer. Small businesses face higher capital costs and more cautious consumer demand. Many local shops survive on thin profit margins, vulnerable to any tightening from banks. Meanwhile, large corporations with better access to capital markets maintain their position, deepening the sense of polarization. The disconnect between data and real life is also evident in how people react to economic information. When positive reports are released, they don't generate a clear wave of optimism in consumer behavior. Instead, there's caution. People prioritize liquidity, postpone large spending, and focus on maintaining stability rather than expansion. This is a sign of an economy where expectations have shifted, even though indicators don't yet reflect it. Another factor contributing to the sense of insecurity is the uncertainty of the future. Many workers are worried not only about their current income, but also about its sustainability. Automation and artificial intelligence are touted as drivers of growth, but from the perspective of salaried workers, they simultaneously raise questions about the place of humans in the future labor market. This uncertainty makes defensive financial decisions more common. It's noteworthy that these changes are occurring without a formal recession. The economy may continue to grow at a slow pace, while the lives of a large segment of the population remain constrained. In this scenario, the feeling of economic instability is not a subjective emotion, but a reflection of a reality where the benefits of growth are not evenly distributed. The discrepancy between data and living standards thus becomes a crucial indicator. It shows that the system may maintain a superficial equilibrium, but the cost of that equilibrium is gradually shifting to households. And when this pressure accumulates long enough, it can reshape economic behavior in ways that traditional macroeconomic models struggle to grasp. To understand why the U.S. economy has been able to maintain a surface of stability while people's lives have become increasingly constrained, one must look at the structural causes that have accumulated over decades. This is not the consequence of a single policy or a short-term shock, but rather the result of how the economic and financial system is designed and operates. The first cause lies in the increasingly deep financialization of the economy. For many years, growth was no longer driven primarily by expanding labor productivity or real income, but by expanding the balance sheet. Rising asset prices became a channel for perceived prosperity, while labor income increased more slowly. This made the economy more dependent on cheap credit and the ability to refinance continuously. When low interest rates persisted, this structure could remain unaffected. But as the cost of capital rose and remained high, the reliance on debt began to become a burden. Businesses, households, and the government all need to adjust, but their ability to do so is uneven. Entities with deep access to capital markets can delay pressure, while the rest bear the brunt immediately. The second reason is directly related to fiscal policy and the size of public debt. After years of using public spending to stabilize growth and manage crises, the United States entered a phase where deficits were no longer cyclical but became a permanent feature. As the volume of debt increased faster than the expansion of the real economy, the system was forced to find ways to maintain its ability to finance at an acceptable cost. In this context, the bond market became a crucial anchor. The government's ability to borrow is not just a financial issue, but the foundation of the entire system. When borrowing costs rise, the pressure doesn't stop at the federal budget. It spills over into the private sector through mortgage rates, consumer credit, and the cost of capital for businesses. The third reason is the changing structure of the labor market. The flexibility lauded in decades has allowed businesses to adapt quickly, but at the same time, it has weakened workers' bargaining power. Income has become less stable, while the fixed costs of living have increased. This makes households more vulnerable to small fluctuations in interest rates and prices. Furthermore, The rise of automation and artificial intelligence creates a paradox. At the macro level, they promise to boost productivity and profitability. At the individual level, they increase insecurity about the ability to maintain long-term income. As the future becomes unpredictable, economic behavior tends to become defensive, reducing the effectiveness of traditional stimulus tools. Finally, wealth inequality acts as an amplification of all pressures. Groups that own financial and real estate assets benefit from past accumulated value and have more cushions to cope with high capital costs. Conversely, those who depend primarily on labor income must adjust their consumption and savings as soon as financial conditions tighten. This disparity is not only a matter of fairness but also directly impacts the sustainability of consumer demand. These systemic causes interact, creating a state where the economy can continue to function, but at an increasingly high cost to people's lives. When pressure is unevenly distributed, macroeconomic indicators may appear stable while the social foundation becomes more fragile. When financial pressures accumulate at the macro level, they don't remain static in reports or balance sheets. They spread throughout the real economy, impacting indirectly but persistently, altering the behavior of businesses, communities, and individual households. At the forefront of this spread is the small business sector. This group has the least access to cheap capital and is most directly affected by high credit costs. When interest rates remain high for extended periods, refinancing loans become more expensive, expansion plans are delayed, and many investment decisions are cancelled not because of a lack of demand, but because the financial risks exceed their capacity to bear them. This slows down the creation of new jobs at the local level, even though the national labor market hasn't collapsed. In local communities, this impact is evident in the changing rhythm of economic life. Consumer behavior has become more selective, and businesses and services dependent on discretionary spending face thin profit margins. As small businesses shrink, economic cohesion within communities weakens, leading to social consequences that are difficult to measure in the short term. The middle class, considered the backbone of consumer demand, is also affected. With high living costs and compressed real incomes, long-term spending decisions are delayed. Home repairs, vehicle upgrades, and investments in education become more cautious. This doesn't create an immediate shock, but it gradually reduces consumer demand over time, impacting medium-term growth. At the level of collective economic behavior, the ripple effect is also reflected in shifting priorities. Individuals and businesses alike are gravitating towards liquidity, risk reduction, and avoiding long-term commitments. In that environment, traditional stimulus policies are less effective, as defensive sentiment dominates decision-making. Capital flows tend to concentrate on larger and safer entities, widening the gap between those with access to capital and the rest of the economy. This spillover effect also impacts the competitive structure. As large businesses with strong balance sheets can better withstand high capital costs, their market share tends to expand. This reduces economic diversification at the local level and reinforces the feeling that the system is operating in favor of already strong entities. More importantly, these spillover effects occur in the absence of a clear crisis event. There are no massive bankruptcies, no soaring unemployment rates. This normalization makes them difficult to identify and address promptly. Pressure is dispersed thinly but broadly, infiltrating every small decision in daily economic life. When viewed holistically, the ripple effect shows that modern crises don't need a single flashpoint. They can progress as a process of erosion, where each group bears a share of the burden, and no one feels the urgency to react strongly. But this very state increases long-term risk, because when the system is weakened from multiple points simultaneously, the ability to recover becomes far more fragile. In formal discussions of the U.S. economy, the focus is often on growth, inflation, and employment. However, as the system enters a prolonged period of stress, the most significant impacts are often found in areas that are less discussed, or considered secondary. These gaps create an analytical advantage because they reflect the true cost of surface stability. One group most noticeably affected but often overlooked is the pure saver. In an environment of persistently low or negative real interest rates, the value of savings erodes slowly. This doesn't create an immediate shock, but weakens households' financial independence over time. For many, adhering to traditional financial norms like saving and risk avoidance no longer provides the same sense of security. Another often downplayed aspect is the shift of risk from the public to the private sector. As governments seek to maintain financing capacity at an acceptable cost, the burden doesn't disappear but is redistributed through the financial system and regulations. Intermediate institutions, from banks to pension funds, become the channels that absorb pressure. Ultimately, this risk is reflected in people's financial decisions and outcomes, albeit indirectly and inconspicuously. Groups of workers with unstable incomes are also often overlooked in macroeconomic assessments. When the labor market is measured by the overall unemployment rate, those working part-time out of necessity, short-term contract workers, or those forced to hold multiple jobs are rarely given adequate consideration. These are the groups most vulnerable to financial volatility, yet their voices are rarely heard in the official narrative. On a long-term level, another less discussed risk is the erosion of confidence in intermediary institutions. As banks, pension funds, and financial institutions are increasingly used as tools to stabilize the system, their role in serving the individual interests of citizens may be obscured. If these institutions are seen as extensions of macroeconomic policy, social trust in them will diminish, even if they operate according to regulations. Another significant blind spot is the intergenerational impact. Current pressures not only affect those currently working but also shape the opportunities of the younger generation. When education, housing, and student debt costs remain high, the ability to accumulate initial wealth is delayed. This prolongs dependence and alters individual economic trajectories, but this is often not reflected in short-term indicators. Finally, non-economic social consequences are also often underestimated. Prolonged financial pressure can weaken community cohesion, increase psychological stress, and change how people perceive the future. These factors don't appear in the statistics, but they directly impact the long-term sustainability of the economy. These overlooked factors don't distort the economic picture, but they do make it incomplete. When the costs of stability are obscured, policy decisions and social expectations risk being based on shaky foundations. And it is in these gaps that systemic risks can accumulate without being recognized in time. When economic pressures don't manifest as a clear crisis, the strongest impact often occurs at the psychological level. In 2026, the United States faces a form of silent confidence crisis, where people's behavior changes before macroeconomic indicators react. This isn't a collective panic, but rather a gradual retreat from expectations that were once considered the default. Consumers are increasingly delaying major decisions. Not only because of high costs, but because of uncertainty about the future. With real incomes difficult to predict and fixed costs a large proportion, long-term commitment becomes riskier in individual perceptions. This leads to an economy where defensive decisions become the norm, reducing the incentive to expand even when surface conditions allow. In this context, confidence in the system's ability to recover quickly weakens. Reassuring messages, even those based on data, no longer have the same effect as before. People are not openly refuting these warnings, but neither are they acting optimistically. Caution is widespread, reflecting an expectation that instability may last longer than anticipated. The crisis of confidence is also evident in the relationship between people and institutions. As economic policies become complex and detached from real-life experiences, feelings of exclusion from the decision-making process increase. People may not understand the details of financial mechanisms, but they recognize that the end result does not improve their position. This undermines social acceptance of technical solutions. At the business level, a similar sentiment emerges. Managers prioritize preservation over expansion, even when growth opportunities exist. This creates a feedback loop where cautious expectations reinforce themselves. As confidence declines, investment decreases, leading to lower growth prospects, further strengthening defensive sentiment. One notable factor is the shift in how people perceive risk. Previously, risk was often associated with short-term volatility. Now, it is perceived as a prolonged state. When risk becomes the norm, rather than the exception, economic behavior adjusts toward avoiding commitment and maintaining distance. This reduces the effectiveness of policies based on quickly restoring confidence. The crisis of confidence also has an intergenerational dimension. Younger generations, having witnessed many shocks in a short period, tend to be more skeptical of promises of long-term stability. Expectations of improving living standards over time, which are a cornerstone of the social contract, fade. As these expectations weaken, the motivation to fully participate in the economic system is also affected. Importantly, a crisis of confidence does not necessarily lead to an immediate collapse. It slows the economy, makes it less flexible, and more vulnerable to future shocks. As defensive sentiment becomes prevalent, the system's resilience relies more heavily on policy interventions, which are increasingly difficult to implement without causing adverse reactions. The crisis of confidence, therefore, is not a peripheral consequence. It is a central part of the modern economic narrative, shaping how individuals and organizations act in an environment of prolonged uncertainty. 2026 does not mark a clear moment of collapse for the U.S. economy. There is no single event that will force the system to pause for self-reflection. Instead, what is unfolding resembles a prolonged process where pressures are managed just enough to avoid an overt crisis, but not enough to address the underlying problems. The overall picture suggests an economy that can maintain its function under stress without exploding. Macroeconomic indicators continue to provide a sense of order, while people's lives must adjust little by little to adapt. The gap between these two realities is not a random contradiction, but a consequence of how the system allocates costs and benefits over time. The key consideration is not whether the economy is stable, but the price of that stability. When the government's ability to borrow becomes the foundation of the entire system, every adjustment must revolve around protecting this fulcrum. During this process, pressures do not disappear, but are transformed and dispersed, often falling on the least responsive groups. Uncertainty thus becomes a permanent characteristic, rather than a transitional phase. As people and businesses learn to live with prolonged risk, the economy changes shape. It becomes more cautious, more fragmented, and more dependent on technical management mechanisms. The ability to recover, which is based on expectations and beliefs, weakens over time. In this context, the crucial question is not when a crisis will erupt, but whether the system can maintain its social legitimacy. An economy can operate with high interest rates, high debt, and low growth, but only if people believe that current sacrifices will lead to future improvements. When this belief fades, the effectiveness of all policy tools is limited. What is happening shows that modern crises no longer take the form of sudden collapse. They appear as a prolonged state where choices become increasingly limited, and individuals' sense of control over their economic lives diminishes. This is a difficult to measure but far-reaching form of risk. Can an economy continue to function sustainably when stability is maintained by spreading pressure across the surface, rather than addressing the root causes? And in a world where uncertainty has become the norm, how will trust be rebuilt?